Once again, everyone, good afternoon. My name is Greg McDermott with Cyber Trading University. I'm in the Forex department. Looking forward to a great morning, afternoon talking with everyone. I know Fausto's gotten everybody off to a great start, giving you his insights and thoughts on how to capitalize on trading the equities market. We're going to take a little bit of a different spin. We're going to change the topic. It's going to be Forex. But a lot of things that you heard from Fausto, you're going to hear from me. You know, things about the educational piece being very important when you're going to become a trader, and the discipline that's required, and all the things that it takes, the psychology and the mindset. We're going to talk about this today. In fact, I have the advantage of we're going to have the opportunity to talk for a couple of days. Not only are we going to speak today for an hour about foreign currency trading, but we're also going to speak on Wednesday night. I'm going to be holding another follow-up, a little bit more in-depth foreign currency trading free webinar for you. And then Thursday morning, I'm going to go live in the market, 8 a.m. Eastern time, and you guys can watch with me as we look for opportunities, put on trades in our FXCM demo account. And again, I'd like to thank everyone from FXCM. They're the sponsor of me being here with you today. We're going to try to make it clear to you why trading FX is a great opportunity, a great way to expand your trading portfolio. So let's get started. We always start with the risk disclaimer. CTU is an educational firm. We're here to try to help you learn. I don't want you jumping on any of the things that we talk about today, particularly in the currency market. As with the equities market, everything's closed, so everything's sort of at a standstill. So please take a moment, read this. Trading futures, trading options, trading equities, trading currencies does it does involve risk, and we want to make sure everyone's aware of that. About Cyber Trading University, the people that I work for, and the people bringing you these great webinars this morning. CTU has been an educational trading institution since 1995. They've established themselves as a leader by first working directly with the SOEs trading firms, teaching them to day trade. For those of you who remember back 20 years ago, they used to call them, some of the firms were called the SOEs bandits, and CTU helped the early trading and training of those day traders. Those day traders really helped establish the market that you're able to trade in now, whether it be equities or options, futures or foreign currencies. CTU was one of the first to establish itself as a quality stock market trading school. Each of our instructors, including myself, has a minimum of 6 years of actual trading experience before they begin working with students. Over the past 14 years, we've helped thousands of students to be successful and profitable traders. CTU's headquarters is located in the heart of the trading world in New York. This is me. My mom always liked this picture. Got my master's degree in applied finance at Macquarie University in Sydney, Australia. People will ask me, I was a Rotary International Scholar, about graduate school, and I always recommend you should get a scholarship and go to Australia for graduate school, particularly at 21, 22, 23. Great place to go to school. At that time, I was the first American who was in that program and the first American to graduate with that degree. Since then, in the Far East, Asia, and in Australia, the Macquarie University Applied Masters of Finance program has become pretty well known. I graduated from St. Joseph's University in Philadelphia with a BS in financial management. I was a crude oil trader and market maker at the New York Mercantile Exchange. Seems like 100 years ago, but it wasn't quite that long ago. I followed that up with a move to the Philadelphia Stock Exchange, where I was the head options market maker for a privately held company called JAS Securities. I managed on the floor at one point a portfolio of about 10 options traders, plus myself. I was responsible to the partners for all the risk. Again, while doing that, I was a market maker for Dell Computers, and at one point, Dell was the largest equity options trading in the United States. We also, for a while, ran an offshore trading operations for JAS, and at one point was qualified through the ISE as a DTR. So that's about me laying the groundwork for my experience, and now we're going to talk about you. And I will tell everyone, I will try to answer your questions as they come up. If I miss them, I would be happy to stay on at the end, answer any of the questions that you may have. I'll also give you my contact information for any sort of follow-up that you may need. But we're going to start, since we're going to be talking for a couple of days, this is the next time, Trading and Money Management 2014 Part 2. It's an intermediate level. It's going to be with me Wednesday night, 7 p.m. Eastern Time, right here, same bat time, same bat channel. We're going to be here with you. And then Thursday morning, my favorite part, love going live into the markets. I'll sit here with an hour for you, 8 a.m. to 9 a.m. Eastern, and we will look at market opportunities as they present themselves, put on some trades. It'll be a lot easier for me to take some of your questions. It's a much more informal hour. You can put out ideas. We can talk about them in the currency market, and I can help you get a better feel as to why FX trading should be part of your trading portfolio. We're going to start, as I said, at the beginning. I'm going to give you a real good background as to what the FX market is. I know everybody knows about the stock market. Even the futures market, a lot of people have a very good feel for. I'm sure some of you have traded options, have or will trade options. But the foreign currency market is a bit foreign, to coin a phrase, to a lot of people. It trades all the time. There's lots of things that make it unique and different. And some people have shied away from it because it's unique and different. They get a little bit concerned, afraid, unsure about what's going on. One of the advantages you have when trading with a firm like FXCM is you've got a reputable broker handling your orders. Your money is safe. In the past, there have been stories and people who have had, problems in the currency market, and a lot of it has to do with, who you're putting your money with. Well, the advantage of FXCM is you've got a well-respected foreign currency brokerage firm there helping you, providing you education like this to help ensure that you're a long-term customer of theirs and a successful trader. But in the simplest form, what is Forex? It's short. It's an acronym for the foreign currency market. It's a market where traders come together to trade underlying currency. We're going to talk about the spot currency with each other. Forex, unlike traditional exchanges, is a wholly electronic exchange. There's no guys or women in ugly jackets yelling and screaming and spitting on each other. Take it from someone who's worn an ugly jacket and been yelled and screamed and spit at by people. That sometimes is not the most effective way to conduct business. It has its place. It is fun to do. There is something visceral about being in a crowd and kind of literally bumping into people and fighting for your position. But this allows you a much more quiet, for you, undistracted market to trade. It's an electronic marketplace where the traders exchange one country's currency for another in a free-floating exchange system. For years and years, this was reserved for governments and large financial institutions. It's only been within the last 20 years, at the dawn of those SOS bandits I talked about earlier, where this market became available to traders like you and me, people who have large accounts and now very small accounts. I mean, you can open up an account at FXCM with, $2,000. You can be up and running and trading with the availability of leverage. So it's available to all. And there's a lot of advantages that we're going to talk about to trading the financial markets through Forex, in addition to the other trading that you may do. First of all, it's the biggest. We're talking about the world's largest market, trading an average, turning over $2.5 trillion a day. It offers you more liquidity in a small space than all the other financial markets in the U.S. combined. And this liquidity spread out over about 18 major currency pairs, although the majority of trading is done, I'm going to pick a number, say 75% of the trading is done in about 6 or 8 pairs. And that does set up for you as an advantage. And I'm not sure about FX. I just saw this FXCM trade in Canada. I'm not sure about that, but I'll bet you if they go to their website, they'd be more than happy to help you. Here's the why of the Forex market. Why should you expand your trading horizons and trade the Forex? We touched on it. First of all, you're looking at the world's largest financial market. Second, and very important, is you can profit in up and down markets. Now, most of you, if not all of you, when you trade equities, have an upside bias. Yes, you can put on a short position. There are position limits. There are entry limits, exit limits. There's margin requirements, which can be significant. So yes, I'm not saying you can't in the stock market trade a stock and short it and make money, but I'm saying it can be difficult. Well, in the Forex market, there is no such barrier to short positions. You can as easily be long a currency pair as be short a currency pair. And that allows you to open up, again, both sides of the trading market. Many, many years ago, with one of the premier equity day trading firms, it was Broadway Trading, and the gentleman that owned the firm I trade for was also a partner in that firm. It was run by two of the most well-known authors in that space, Mark Friedferding and George West. And I went in and sat through their training, and at one point they talked about trading, and they drew this ABC pattern. Stock moves up, pulls back, buy it on the pullback for the move back up. And I asked them, I said, what about a trade to the downside? And it was almost like you heard this hush in the room, and everyone looked at me as if I were a heretic, as if stocks could ever go down. Now, again, we were probably talking about 1997, 98, somewhere in that time frame. So at that point, honestly, a lot of them didn't go down. But this market allows you to profit. So strategies that you have that work on upside and downside, taking out support levels and a downside move, you can benefit on those because this market freely trades to the upside and the downside. Forex is open 24 hours a day, 6 days a week. Now, what's that mean to you? Well, market's going to open tomorrow night, East Coast, probably about 8 o'clock or so. Our friends in the Asian market will get things kicked off Sunday night. And then the market will be open 24 hours a day until about 4 o'clock or so Eastern time in New York. So if you're someone who has a 9 to 5 full-time job, you can find a market to trade in. The European market trades early in the morning. Or if you're someone who's a bit of a night owl, more like myself, you can maybe trade that Asian market and put opening positions in and watch the markets from, I'm making up a time, 10 o'clock, 9 o'clock till, noon, until midnight Eastern time. So you don't have to go quit your job. You can find an area that trades. You can learn how that market trades, and it's available to you whenever you want. The availability of a small number of currency pairs does allow for a bit of specialization. You can get used to the movement and the pattern that a currency pair trades. Now, I've been on calls with Fausto when he has called back to his students and said, hey, we've traded this stock. Remember a couple of weeks ago when we traded it and we were able to get the same kind of a move? And if you trade the same stocks repeatedly, you get kind of used to the way that they move. Well, there's a large number of stocks for you to become proficient in, but in the currency market, 6 or 8 stocks allows you to, 6 or 8 currency pairs that are active allows you the opportunity to quickly get up the learning curve and learn some of the nuances of each of those currency pairs. Risk management tools that are better, analytical tools that are better. FXCM offers great tools that allow you to manage a trade when you're in it, or determine what trades you want to get in by using any of the tools that they have available. You do have a bit of immunity to the manipulation of the market. There are no CEOs. There are no insider traders. The market is just too big and too large for any sort of extended fooling with the data. And again, margin is a big advantage. You can margin depending on where you are in the world and your brokerage firm. Some brokers will offer a 50 to 1, 100 to 1 margin. You can, in some cases, get a larger margin than that. And although margin can be attractive, I just want to put a warning out there. You don't want to be caught off guard. You don't want to be thinking that, well, because I can get a 100 to 1 margin, I need to push all the chips into the middle of the table for every trade. That's a recipe for disaster. That's gambling, and that's not what we talk about here at Cyber Trading University. What we talk about is trading, allocating a certain portion of your capital at risk at any trade, and trying as best you can to mitigate the downside risk while profiting as best as you can on the upside. back to the data. Because the Forex market is so large, no market or group is able to manipulate or control these prices. You're not going to see fraudulent government data coming out unless you're someone who believes that all government data is fraudulent. Then that's probably a discussion for a different day and a different topic. There are no whisper numbers. We don't have insider trading here. We're looking at a level playing field for all involved in the market. You do have fundamental analysis. So if you look at the information that a government will put out, whether it's the United States or other foreign governments, those economic numbers impact the currencies that you're trading. Because at some level, very, very, very simplified level, if you buy the British pound US dollar currency pair, you're effectively saying, I believe that the British pound is going to increase in value versus the value of the US dollar. So again, very simplified, I'm saying Great Britain is going to go up and the United States is going to go down. Now, please understand, that's an oversimplification just as an analysis, an analogy for you. But the economic data that drives a country's resources and drives a country's economic development can and does impact their currency and how it trades versus the other currencies in the world market. So that is another area that you need to be familiar with and look at when trying to build a history and a trading strategy in the currency markets. The analytical tools, we talked about this. You saw that one screen Fausto just had up a little while ago, and it was, covered in information. And I'm sure some of you, it made your eyes, burn, and others were very, comforted and soothed. They like to see all that information. I'm one of those people that doesn't mind a lot of information on a screen. I enjoy watching the stock ticker go by at 2 different speeds and watching both numbers. I enjoy trying to analyze a lot of data, particularly that on the charts. In the old days, again, dating myself 20 plus years ago, if you were a chartist, you were somebody that had to get a book, and the book would come out once a week, and you would, in between the publishing of that book, you would by hand fill in the price points, whether it be a candlestick. George just mentioned liking a candlestick chart, and I'm with him on that. But you would have to do it manually. And those people were the early believers in charting. Well, now anybody with a brokerage package, somebody like FXCM, has analytical tools that 20 years ago were just unheard of, unimaginable. And now you can do all kinds of analysis at the click of a mouse. You can do momentum studies. You can look at relative strength indicators. You can look at Fibonacci's. You can look at all the different things. You can draw in support and resistance lines and look at pivot points and all those sort of things that years ago none of us would have been able to afford the horsepower computing-wise to make that work. It's now as commonplace as, your kids playing with their iPhone. You can get it on your iPhone for that matter. So it's available to you, and it helps all of us become more analytical and better traders. The thing I like about currencies is that they do, although volatile, they do have long, persistent trading trends. And the advantage to that is, what kind of trader do you want to be? We're going to talk about that over the next couple of days, but it allows you to say, I want to be a long-term trader, and I want to put on a position that I'm looking at daily charts for, maybe even weekly, probably not that daily, but within the movement of a long, persistent, say, move to the upside or move to the downside when looking at only daily charts. There are smaller time frames that, if your schedule allows, would bring you the opportunity to trade on a 15-minute chart or a 5-minute chart and find opportunity, small volatile bursts within a longer persistent movement, either to the upside or to the downside. So if you're someone that wants to put a trade on and put your stop and your limit in and walk away from that trade because of your circumstance or your trading style, you can do that and look for a longer term. Now, you do need longer, bigger stops to be able to carry longer term positions. But then if you're someone who's got the ability to sit in front of a screen all day, there are short-term opportunities day in and day out in the market if you avail yourself of them. I mean, here's a weekly chart for the pound US dollar. each one of those candlesticks, the green being ups, the red being down, is 1 week. I mean, that goes back to the middle of September, almost 2 years worth. So you can see that since about June, and if I grab my little notator here, if you grab my down here, I'm going to change this color so it's a little brighter so we can see it. Let's do a nice red. So if you look here, since this point down here at the bottom, we've had effectively, if you looked at it, a straight upward move, more or less, in the currency pair, the pound versus the US dollar. And that's, again, at a weekly level. But if you take a little bit of a closer look, I'm looking here on a 5-minute chart. Now, that last chart, if you look at it, showed us that's weekly. That's 2 years worth of data. This chart was a month ago, back in February, I cut this chart, and it's, we're looking at about 12 hours worth of data here. Each of these bars being 5 minutes. And again, there's opportunity in these movements, and that's what we're looking for. You can capture a short-term movement within a 5-minute or a 15-minute or a 1 hour or a 4 hour. Some people even like using the 1 minute charts. But laying these out there and looking for opportunities with pivot points, looking for opportunities with Fibonacci's and any sort of the other things we're going to talk about over the next couple of days, your time frame can be traded, whether it's long or short, in the currency market. Again, stop loss orders offer a more effective tool in the Forex than other markets. Most people believe that a stop loss order protects them, for example, in the equity market, from a loss overnight. And the reality is it's not true, because a stop loss order is only active when the market is active. And once a stop loss is triggered, the movement of the execution of that trade becomes a market order. So in an example where you have a stock trading at 50 and you have a stop loss at 40, bad news comes out overnight while the market is closed. First print on the stock the next morning is 30. Your stop loss at 40 is then executed and becomes a market order, and you get locked in at 30. But because the currency market doesn't close, those stop loss orders are in place and protecting you, as long as you don't leave them open over the weekend. You've got the effectiveness of using stop loss orders that are working for you all the time. There also are the ability to trade foreign currency options, which we will touch on later in a couple days. The foreign currency options can be a risk management tool as well as a speculative tool. And again, free of charge with our friends at FXCM. The other thing I do want to talk about, here's the opportunity. Today, it's just easier than ever to stay connected to your trading. Fausto mentioned that the Twitter feed that he uses to send out trades and allow our students to know exactly what's going on. Well, you don't need to be sitting at a desk to get your Twitter feed. And most of you, I'm sure, if you look at here, I'm used FXCM, you can trade on their web trading station. You can use MetaTrader. They have mobile trading apps. So wherever you are, you can access the market, you can execute, and more importantly, and probably more effectively, monitor your trades. So in the old days, if you wanted to trade with Fausto Trading Equities or traded foreign currencies, you had to think about, being unemployed, because most of us you go to a job and you can't trade from 9 till 5 with your screens up all the time. But the availability of technology, wireless, and the such allows you to stay in touch with the market while still working your full-time job, until, of course, this becomes your full-time job. We're going to talk about the language of FX so that we all understand. We're going to talk about how we get into this market and what are we really trading. Then we're going to move into, on Tuesday, a little bit more advanced idea of how do we get in and out of trades, how do we manage trades that we're in. So we're going to take the time to talk about the basics. Again, most of you who are with us today are new to foreign currency. We want to make sure everybody has a base of knowledge. Currency pairs are abbreviated as such. The big ones that trade: US dollar, British pound, the euro, the Japanese yen, the Canadian dollar, the Australian dollar, and the Swiss franc. That's the normal, the biggest of the trading. You will see the New Zealand dollar trades a decent amount. But in general, look at these 7 as kind of the top. And what are we talking about? A currency pair. It's the exchange rate of a currency pair is the number of units of the counter that one unit of the base currency can purchase. So let's think about that. The base currency is the first one in the pair. So in the pound dollar, the base is the pound, the counter is the dollar. So it's a little bit different because you're used to just buying a stock and everything's denominated in US dollars. Well, in this case, it's very possible that you're going to be talking about something other than US dollars when you're putting a trade together. For example, like I said, the pound dollar, the base currency is the first in the pair. In this case, it's the pound. And that currency, if we're buying, that is the currency we bought. The counter currency, in this case, the US dollar, that's the one that we're either selling or borrowing if we buy this pair. And you have to remember that the currency pair always represents the simultaneous purchase and sale of two currencies. What am I doing in the pound dollar? I'm buying the pound and I'm selling the dollar. If I sold that currency pair, I'd be selling the pound and buying the US dollar. And again, anybody who's in the United States, don't worry, it's not un-American to sell the US dollar, particularly if there's money to be made. So that's what you're looking at. It's a pound versus a dollar. It's a relationship. You can even look at it as a ratio because that's how you can think about it. Most of you don't realize it, but you already use an exchange rate every day. I'm going to use this example, but if you purchase 1 gallon of gasoline at $4 US, you are exchanging or selling $4 US and buying 1 gallon of gasoline. And if you look at this transaction, what is your base currency? It's gasoline. And what's your counter currency? It's the US dollar. So you have to get out of the mindset, if you're in the United States or whatever country you're in, of thinking everything in terms of US dollars, or if you live in Great Britain, British pounds, or if you're in the EU, thinking of everything as euros. If you're, Japan, everything is yen. It's just a relationship. And in this example, gallon to US dollar is the rate is $4 US. So that's how you look at a currency pair. It's an exchange. We are selling our dollars and we're taking possession of gasoline. And in this case, if we were trading that, again, we don't trade it because we execute that trade, then we burn the gasoline in our cars, and then, or where I live these days, my snowblower, and then we no longer have it. But when trading, you're going to put the trade on, and then at some point in the future, you're going to execute the opposite trade in an effort to profit. If you've sold the currency pair, you're going to hope that that pair goes down. And then if you've bought the currency pair, you'll hope that that currency pair will appreciate. You do the reverse trade, and that's how you profit. Pound dollar, the base is the pound, the counter is the dollar. The normal quoting of the US dollar yen is dollar yen, not yen dollar. So in that case, it's the US dollar is the base and the counter is the Japanese yen. So here for our currency pair, the pound dollar is equal to, in this case, 1.975. What's our base? The pound. What's our counter? The US. What does this quote tell us? It tells us that it takes $1 in this example and 97.5 cents to equal 1 British pound. Now that's an old example. Pound's trading now probably what, like 140-ish, 43, something like that off the top of my head. I don't remember from Friday. But again, because it's pound dollar, it's how many US dollars do I need to get 1 British pound? Now, if we look at the next example, if you did it the other way, if you quoted it as US dollar versus pound, again, you still have a relationship. You've just reversed the players, we now have a base currency of USD. We have a counter currency of British pound, GBP. And what does that quote tell us? It tells us that in order to get $1, you would only need 0.5063 British pounds. So again, there's an inverse relationship between the pound dollar and the dollar pound in this case. So what I'm saying is we've got two ways to quote this currency pair, although the normal quote is pound versus US dollar. These pairs have a mathematical inverse relationship. And if you look at it, if you take the 1.9750 and you divide 1 by that number, you're going to get 0.53. Oh, thanks for the 1673. I appreciate that, Trish. I'm getting old. I think I was thinking euro. It's been an early morning here for me. The pound versus the dollar is a 1 US dollar divided by the ratio gets us back to approximately half a British pound. So that's that mathematical relationship will hold, and it has to hold, because if it didn't, there would be opportunity for some smart traders like you guys to make money. And here's how it would. Everyone's heard the word arbitrage, and there's a lot of misconceptions about arbitrage. First of all, people believe that you can take risk and execute an arbitrage, and by definition, it's not, because arbitrage is the risk-free trade, and very rarely, if ever, will it happen. I like to think of arbitrage as it's sort of the mathematical governing principle that keeps prices at least mathematically in line, not necessarily structurally. And what I mean by that is on a chart. It doesn't keep the pound or the dollar at a certain level, but it makes sure that all the relationships that come from that pair, in this case, stay in line. And the analogy would be to gravity. Gravity is out there. As a comedian once said many, many years ago, Harry, the guy who used to be on Night Court, I can't think of his name, Harry, but his old joke was, remember, gravity is not just a good idea, it is the law. Well, he did this while he was levitating a table, and probably on the David Letterman show, which shows how old I am. But gravity is out there keeping everything in balance, and arbitrage keeps these things in balance. And I've given you a mathematical example. If the quote was pound dollar 1.975, and it was also at the exact same time dollar pound 0.6000, there would be money sitting on the table for you to win, to take free off the table. And you can be quite sure that all the traders in the world all know what we know. And if you ever see something like this, the first question you should ask yourself is, what don't I know? Because if this relationship was out there during the market hours, our friends at Goldman Sachs and all the other trading firms would be pounding this trade into oblivion, eliminating the arbitrage opportunity and the free money. So what would you do in this case? You would sell the pound dollar at 1.9750. You would buy the dollar pound at 0.600. And what would happen? When you convert that, you'd end up at buying it at 1.6667. Therefore, you would have sold it at 1.9750. Pardon me, you'd have sold it at 1.9750. You'd have bought it back at 1.6667. You'd have made 30.83 cents in free profit. And that last line is there for a reason. You're never going to find this trade because in the old days, there was opportunity. When computing power was not what it is today, 20 years ago, I used to stand in the crowd, the old days, trading options in Dell, where I didn't even have a computer at my access. It was at my house in New Jersey. And I would print sheets every day and carry them in on the train and hope that we wouldn't go outside that trading range. And then when the gigantic technology hit, I got this little tiny HP calculator that was a little bit bigger than the HP 12C, but it flipped open. And I'm quite sure that the the most basic smartphone right now probably has 1,000 times the computing power that had. And in those days, if you had computing power, you had advantage. Well, now technology and the availability to all have really run that out of the market. But even though it's not there, again, like gravity, it keeps these markets in line. It keeps the availability of those relationships tight mathematically so that you know that you're trading within the parameters of these pairs. The contract size, a basic contract size is 100,000 units. Now you're saying to me, Greg, I don't think I can buy 100,000 of anything. In fact, the way things are going, I'm not sure, 100,000 pennies feels like a stretch at these days. And I get that. But because of leverage, you don't need to have, the exact dollar amount. And we'll talk about that in a minute. But a current, they'll call it a round lot or a lot, which is 100,000 of the base, the first currency. So if you had a 6 lot, you would control 600,000 of whatever the base currency is. You'll also find a 10,000 unit. They call it a mini lot. I'm not sure if FXCM offers a micro lot or not. If any of you out there may know, but a micro lot is a 1,000 unit, so a very small account. But with a 10,000 unit base currency, if you had 6 mini lots, you'd be controlling 60,000 of the base currency. Pardon me. When you're talking about the movements, we call it a pip. It's the smallest unit of measure in the FX market. It's an acronym for percentage in point. A lot of futures markets will call it a tick. It's the smallest movement. So in the Euro USD at 1.570, it will be the last decimal in the quote. The normal market's going to show you that 0 being the tick. You look at some trading platforms. I know, for example, FXCM will even go one more decimal point below 4. So you would have, you could have 1.5750 and then another number, again, to get the market even tighter for you. That can help when trying to enter and exit trades, being able to get even tighter inside of whatever the current trading market is. And what's the value? 100,000 units in this example, pound dollar. If it increases from 1.9750 to 1.9760, you have 1 pip is worth $10. Again, a full lot, 1 pip, 1,000th of it gives you $10 on every pip. If you're long £1 in this scenario, up 10 pips, you make 100. Again, if you're short 5 though, and it goes up 10 pips, you lose 500. There's that double-edged sword of leverage. Yes, it will allow you, and people are thinking, man, if I got this thing to move 20 pips on a 1 lot, I can end up making $200. But you have to be aware that you have the same downside, and that same acceleration always feels worse. Trust me, I know. Always feels worse on the downside rather than the upside. If you're looking at a mini lot, which a lot of you may start trading, and I would recommend in your in the demo account that you can open along with your trading account at FXCM. I would open a demo account, but that 10,000 unit allows you in the Aussie US, if it increases from from 0.9590 to 0.9600, that's with 1 pip being $1 US. If you're long 1 Australian US dollar and it goes up 10 pips and each pip's worth $1, you can all do that math. You make $10. But if you happen to be short and were wrong 5, you leveraged up too much. You end up with a $50 loss. And again, $50 loss doesn't sound like a lot unless you got a $200 account. Then you really put yourself at risk. Same thing here. Long 6 euros at 1.5750. It goes up to 1.5775. What's our profit or loss? Profit's $1,500. We had 6 contracts times 250. How do we get 250? 25 pips times 100. So there's money to be made. And again, a lot of people, and I like the idea of having a target for trading and figuring out what am I willing to lose first, and then how much am I willing to make while losing this amount. And if you can set that up, I know a lot of people that make their number during the day and then take a walk. If you get to a point where, hey, my goal was to make $200 today, you want to make sure that, you get your 200. And there are people, some days the best thing to do is walk away. Now, I'm not saying that all the time, but, you can do this because, again, this is not a casino. We're not trying to gamble. We're trying to put as much of our educational force behind you to give you as big an advantage as you can while doing this job. And it is a job. This is not gambling. You're not going to be out here trying to, retire tomorrow. If you figure out a way to do that, you've got my email. Please email me. I'd like to know how to do that. Another example, that same $100,000, you're long, and it goes against you 20 pips. Well, you lost $600 because you had 3 contracts on. You lost 20 pips, each pip worth $100. You have a $600 loss. Same example works here, showing you how if it goes against you on a $1 contract and you had 6 of them out there, you could lose $270 on a 45 pip move. Even though they're only $1, you had 6 of them out there, you lost $270. I'm going to jump these. I want to show you a trade here, that an opening trade with $100,000. What is really happening dollar-wise when you make these trades? Opening trade, U.S. Canadian. 100,000 U.S. dollars is exchanged for 99,500 Canadian dollars when our exchange rate is 0.9950. We did 5 of those, so we now have 497,500 Canadian dollars. When we close this trade, the Canadian dollars worth 100,500 Canadian can be exchanged for 100,000 US, because the exchange rate is going up to 1.0050. So we now roll this backwards. We now have 502,500 Canadian dollars. Subtract out our original purchase of 497,500. We end up with 5,000 Canadian dollars. And when we convert that back to US dollars, we end up with about, based on the exchange rate, just under $5,000 profit. So I just wanted to show you, you are exchanging dollars, in this case, dollars for dollars, US dollars for Canadian dollars. I want to talk about the bid-offer spread. A lot of people get I know in the equities market it can be difficult. I've had people who I've taught equity option trading to, and they would complain that their trading strategy was fantastic, but the market was too wide and the bid-offer spread was too wide, and that's why they were losing. And I'm here to tell you that if you believe that the only reason you're losing money, that your strategy is sound but the bid-offer spread is too wide, you need a new strategy or a new underlying to trade. Trading the spread is it's part of the market. It's part of when building your strategy. When you're buying gasoline, I touched on it earlier, you've got a one-sided market. You pay $4, you get a gallon of gasoline. But in a two-sided market, something like real estate, one buyer submits a bid, the other buyer submits an offer. That's what we've got here in the currency market. Financial markets, buyers are always bidding, sellers are always offering. Now, this does refer to long and short contracts, not to the direction needed for profit, because you could be a seller of, for example, puts, and all things equal, you would make money if that went up. So again, when I'm talking about long and short here, it's not directional, it's ownership. And you're always going to have a buyer be the bidder and a seller be offering to create a two-sided market. This is something that I learned pretty much the best way you can learn anything. I was working on the floor of the New York Mercantile Exchange as a point clerk. Now, I used to clerk for a couple of guys who traded options. We had one guy that stood on top of the podium where our phones were. The booth was about, I'm looking at my hands, they were about 24 inches wide. He stood there with 2 phones at his feet. There would be days where I would do that job, but this particular day, I was standing with my back to the crude oil crowd. My futures trader, literally, were back to back, and I took an order from my options trader in the crowd. Now, when you're doing hand signals, it's very simple. When you're bidding, if you ever watch any of the footage from the guys on the floor, women on the floor, if you see the back of someone's hand, they're bidding. If you see the palm of their hand, they're offering. So that's how you can tell whether it's a bid or an offer. Well, long story short, I took an order from my guy in the crowd. I relayed it to my futures broker. We executed the trade, and I executed the trade correctly, but I hand signaled it back to my trader the wrong way. And I didn't do it price for quantity, which is a bid, or quantity at price. You would tell someone if they bought something, you paid 6 for 25. You wouldn't say you bought 25 at 6. Well, I misquoted it on hand signals. And the trader, luckily it wasn't very crowded, so he had the opportunity to come running out of the crowd, screaming at me, embarrassing me, and making sure that I knew clearly that it was price for quantity on a bid and quantity at price for an offer, and there was no alternative. And nothing better than being embarrassed in front of a trading floor to make sure that you take that price for quantity, quantity at price to the grave and be quite sure I will. So I don't want you making that. When you're talking about it, when you're executing a trade, you're going to say, if you were bidding 75, you are 75 bid for, in this case, 10 British pound US dollars. Your price for quantity, the word for. If you're offering, you've got 10 at 75. That means you've got a certain number at 75. And it all goes back to hand signals, because if I'm delivering you numbers, you have to know what number I'm talking about. If you're saying you're 75 bid, so I'm 75 bid for 10, so you do the signal that shows 75, and then you are buying 10, so you're putting up one finger, because that with your back, the palm, the back of your hand facing the person you're looking at, and you're saying you're buying 10, you'd hit your forehead. So I'm sitting here in my office tapping my forehead like a dummy, as if any of you could see me. Old habits die hard. Same thing, quantity at price. I would sell 10 at 75. So what am I doing there? I'm showing them I'm selling the quantity at the price. So that's the way a bid-offer spread works. In this example, what's the bid? 5677. Our offer is at 5679. What price do you, if you were in this market, where would you buy 10,000 euro US? Well, you would buy it on the offer, because you're not making the market. And where would you sell it? Pardon me, you're selling it on the bid. In this case, our market's 2 pips wide. In this one, we're looking at a bid of 197.45. The offer is at 197.49. If you were going to buy, you have to buy on the offer, because that's the market. You could bid in between the markets, but there's no guarantee of execution. Where would you sell? You would sell by hitting the bid. Again, you could offer at 197.47, no guarantee. You would then become the offer in the market. In this case, we're looking at a 4 pips wide market. I was going to try to show you FXCM, and of course I put this in here to look at the bid offer spread live, and there's 2 versions of FXCM, and the one I wanted to show you is down for maintenance. Of course, Murphy's Law working again. Let me just show you quickly though. I will show you my desktop. This is MetaTrader 4 in FXCM, and you can see, I'll take the pen here and just draw a quick line so you can tell where I'm looking. These columns right here are the bid and the offer. Now, understand, the bid and the offer right now are very, very wide because the market is not open. You normally would see markets much more closely tied than this. So that's where you would see them. You can also, some of the chart packages will give you, like for example, I run this market price, and what it does is it'll tell me what's the market price, and it tells me, if I can show you right here, it'll show you right here, this 2.9 tells you how wide is the market right now. So I can look at that quickly and get an idea how wide is the market that I'm trading before I enter the market. So just wanted to show you live. This is the FXCM MetaTrader 4 platform you can use when you go to MetaTrader and sign up for a live account and a demo account. They will give you this. The charting package is phenomenal. Again, not live right now, but it allows you to do very nice, easy things like, for example, let me bring up, I'll just show you real quickly some of the tools that they have here since we're in here. Let's look at line studies. Just going to throw in the line studies. Where did it go? Come on. Show up for me, guys. Okay, line studies. For example, let's say just simple click. Let's say you wanted to look at a Fibonacci. Now we're looking at a 15-minute Euro US. I'm just going to draw this thing on here real fast just as an idea. But real quickly, you can drop a Fibonacci in here and see where is this thing traded and use this as the beginning of where might I want to enter or exit a trade. Obviously, this area down in the bottom here by this last pivot point should be a bit of a short-term support area. So if you're trying to enter a trade on the long side, you probably want to make sure that your stop was below there and you were comfortable with, in this case, trying to grab the pointer. You know, let's say you could start a trade right here. You drop down and say, okay, I'm about 70 pips below. Am I willing to have a 70 pip stop? Again, don't do this trade. I'm just doing it as an example to maybe assume that this thing may retrace back to its 23.6 level on the Fibonacci. Again, that's not a trade, just an example. Wanted to touch on the FXCM MetaTrader 4 model. The other trader that they have is more of a digital, less charting, allows you to enter a little bit more number-centric, but it's not available right now. It's up for me. I tried to log in earlier. It's up for maintenance. So we're back here. We've got about 10 minutes left in our presentation. 7 minutes left. It really is the bid-offer spread is the main source of revenue for the markets and the market makers and the brokers. Some brokers will offer you commission-free and commission. You probably want to ask your broker, how do they trade? I'm pretty sure FXCM is a non-commission broker, which means when you execute a trade, the fact that your bid-offer spread might be a heartbeat wider than Oh, by the way, Phil, if you're going to do that, okay, you know what? Just nobody do this, okay? I've said that. Everyone, can someone please tell me they heard me say, don't do this trade? Phil, you heard me say this, right? Don't do this trade? Okay, everybody, don't do this trade. I don't want you jumping into that trade just because of that. Here's what I would look at if I was going to look at that trade live. That was a 15-minute chart. I want to look at, this one's a little hard to see. I want to make sure that the properties are correct so you can see background. I want to make sure it's apply this. I'm not sure why I can't get rid of this. Make it white. Well, I can't change this chart, but in general, you've got a couple things working here, Phil. You've got a resistance. This is a daily chart, guys. So that red line is a resistance level. And you've also got, if you want to draw in, there's two ways you could draw this support. You could come all the way down to here. In fact, now let's do this. Let's draw this in from, let's draw it in from here. And you could say, okay, we're on a rising pattern here. You can see my movement average is turning upwards. Again, this is a daily chart. And you could also go back to our friend Fibonacci and say, okay, from this point here, which was a while ago, September, again, a little hard to see on the yellow. I'm trying to, this is where was our high point? We'll call it, I hit here twice. I'll put it here. That Fibonacci is very hard to see. I apologize. If you change the background, maybe you can see it better. Make it black, see if that works any better. Well, that works. That was worse, guys. But okay, my point is the Fibonacci would help us. I'm going to change that back to white. And okay, there's a Fibonacci, and this thing is bouncing on the. It's been playing off these numbers. So there's clearly a resistance level up here, and it's been there twice. Somebody wants to go old school, You could almost maybe even do an inverted head and shoulders if you want to look at this thing. But my point is, so I kind of have a pattern moving to the upside on the daily. So now I want to look at the other stuff. You can't just say, hey, the daily's looking good, let's buy this. And it's back to our original point. We'll talk about this in a couple of days. Look at the 4-hour. What's happening in the 4-hour? In general, we are sort of moving up. But you may look at, I'll draw that trend line again. If you want to draw this trend line in here, there may be some movement before this thing comes back to some support. So jumping in to buy this trade, thanks for the gray. That's a good idea. There may be a little bit of drop. Let me show you what I'm talking about. From here to here before I get some support. That's a 600 pip move. Maybe I need to find a little better entry. So I kind of like it on the upside from the daily and the hourly. I mean, the 4-hour. Let's look at the 1-hour. Okay, 1 hour, we had that big move, a couple of back on this number. This chart's not live, so don't get too crazy here. But what I'm telling you is, I would look at the 1 hour, and then I'd probably try to find myself an entry here using this 15 as the entry. I would maybe look at being able to jump in. Again, this chart's old, so be careful. But what I'm trying to show you here is when I look at a trade, I don't look at just one chart. I try to find where are the entry opportunities, because in this example here on this 4-hour chart, yes, I sort of have an upside. It feels like we've got an upside move going here, but there's a lot of room to be wrong between here and here. And I could get taken out of my trade. Unless I can find some support to buy against, I may want to not do it. Or, I know this sounds crazy, but if I was doing it, I might try to find a reason to get short here. And I have an example coming up on our next session where I was able to get into a trade. It was sort of like this, where I looked at it and said, I kind of like the upside, but there might be an opportunity to sell it down to a level like this, buy it, make a little profit on the downside, and then capitalize, kind of get 2 trades out of 1. It happened to work out that time. We're going to talk about that in the next class. Let's go back. So yeah, just don't go do that trade, but you may want to take a look at it, do your own analysis. We can talk about it on Wednesday and Thursday. The leverage here, again, you can go margin up to 100 to 1. It's really great that allows you the leverage to control this kind of currency, but please, please, please be careful. I'm fond of telling people, as you figured out, my analogies are pretty consistent. Water is a great thing if you're thirsty. Not so great if you're at the bottom of a deep pool. And that's what leverage can be for you. It can be very useful trading tool, but you can't let it turn it into gambling. You can't let yourself leverage yourself out on every trade. You have to find what works for you with losses and targets for profit and work within that time frame. And the key here, our last point, it is the money management. And I even applies when those days when I'm lucky enough to sit down at the blackjack table and play a little. All of us know how to play blackjack, and most times the successful blackjack players are the ones who manage their money better than the others. Everybody here knows you want to hit on a 16, and blackjack's the best hand you can have. Same thing with this. A lot of you have traded before and probably understand how the stocks move. Fausto touched on it earlier. The way you end up losing is by not managing your capital. You need to understand. I'm a fan of writing down when I get into trades, where am I getting in, where am I going to get out, and as best I can, sticking to that. Someone mentioned earlier trailing stops. It's one of my favorite ways, particularly when a trade goes into profit, to manage a trade, because we can't watch the market 24 hours a day. But if I can get a trade that goes into profit, a lot of times if I've got to step away and I've got to be using my phone and not sitting at my screens, I use that trailing stop as a way to stay in a trade. I'll even sometimes increase my price target for profit, knowing that I've got a trailing stop coming in. But you really need to have a plan. You need to have a plan that you can ride out being wrong. In fact, if you look at this $5,000 investment, if your risk tolerance is 5%, you're willing to lose $250. If your tolerance is 2%, you're willing to lose $100. And I like to use a profit target of about 2 to 1. can't hold to it every time, but as an example, if you do that, if you go 2-to-1 with the profit target, with 5% you're trying to make $500, with 2% you're trying to make $200, and on a trade with 1 pip is $1, that's a big movement. 20,000, much bigger, but the same idea, 2-to-1 profit to loss. And I'm going to end with this. The math is real simple. You only need to be right 1 out of 3 times if you hold to the 2-for-1 math. Now, again, that's just to break even. None of you have logged on and spent your time today with Fausto and I to break even. But that's what you need to understand, the power of that math. If you make twice as much on the winners as the losers, if you're right 50% of the time, you're an enormous winner. And that all comes from simply managing your risk capital. So it shouldn't be the case that you try to have the numbers be a break even, but they do prove that you can be wrong more than you're right and still profit when trading FX. And the question I have for you as we end is, do you have the discipline to prove the math right? I really appreciate everybody being with me today. We are offering at the end of the month, I'm going to be doing our triple play course, a little different than what you may have seen in the past. We're offering it. It's not going to be strictly focused on, in this case, FX. It's not going to be strictly focused on options. We're going to talk about equity options. We're going to talk about foreign currency options, and we're going to talk about Forex. What we're talking about is trading. We're not going to pigeonhole you into one. It's a great course. It's going to run, it's 4 one-hour sessions over 2 nights, sponsored by FXCM. If you deposit money into a new account with FXCM, it costs you $37 to join us for the triple play course. I would love to see you at the end of the month. You can follow that link, cybertradinguniversity.com, triple play package. I'm going to put up right now my email address, gregm@ctutrading.com. This is going to be a great course. Again, end of this month, we're going to be doing it again. We got some great results, great feedback when we've run this in the past. I want to see everybody come back. We're going to go a little bit more in depth with FX on Wednesday night the 12th at 7 p.m., another hour, followed up by our live trading Thursday morning at 8 a.m. I really like going live with everybody. Much easier for me to answer your questions, have more of a conversation, answer specifics, look at specific things, try to show you hands-on how do you turn the knowledge that you've picked up and the knowledge that you'll gain into pips in your pocket. You can reach me at any time. That email address, gregm@ctutrading. Please email me. I've also got a copy. There's an article that I wrote a while back, and it's called Pips and Pairs. For anybody out there who is brand new to FX, and all the stuff I said today was a foreign language to you. When you send me the email and ask for a copy of the slides today, ask for a copy of the article. We'd be happy to send that article out to you along with the slides from today. I hope everybody has a great weekend. I look forward to speaking to everybody again on Wednesday night. And please consider going to our website. You'll see all the information about my triple play package at the end of the month and the details about our next 2 tradings. Everybody have a great weekend. Thanks very much. Yes, George, the recording will be available. I'd assume it's going to be up by, I would assume it'll be up on Monday.